Good afternoon, ladies and gentlemen, and welcome to today's webinar brought to you by Trevor Palmer, a specialist property insurance broker, and myself, Nicholas Kisson, a senior advisor at LEASE and a solicitor. We have muted everyone's phone, but feel free to send in questions. You can type in questions in the chat box on the right-hand side of your screen. And I propose to take any questions at the end of the webinar, which is scheduled to last about an hour. And I put up there on the screen the disclaimer, which I shall read to you. Whilst we make reasonable efforts to ensure it is accurate and up-to-date, information and guidance in this webinar does not and is not intended to amount to legal advice in any particular case. No responsibility for any consequence of relying upon the webinar material or presentations of the webinar is assumed by LEASE or any of our advisors. The law as stated during this webinar is as at today's date, the 9th of December 2015. And that is our topic for today, property insurance, how to avoid changes in policy terms impacting on service charges. And I shall now hand you over to Trevor. I'll be popping up at the end to take you through some salient case law.
Thank you, Nicholas. Good afternoon, everyone. Yes, I'm Trevor Palmer from Pi Property Insurance. What we're going to talk about today, some of these we'll cover in greater depth, others we'll look at in sort of a lesser viewpoint, but be happy to take questions. I do have some handouts that you can request later on if it's of interest to you. Be very happy to send more information to you. First thing I'm going to concentrate on is the FCA. Very important as to who can transact insurance. I'm just going to touch on a few areas there because one in particular is often misunderstood and can create issues if it's not correctly addressed. I'm going to focus very much on the quotation process for when looking at property. Principally, we're focusing on leasehold property, residential or mixed developments for residential and commercial. And the main crux of the presentation is looking at some policy wording changes that we've seen come in over the last 18 months to 2 years that are often not fully understood, not really made very clear, and obviously we all know the amount of paperwork that we get issued with, it can get lost within that. So I'm going to focus on some very specific areas that could have a huge impact and increase your uninsured losses if it's not taken into account. So those exclusions and conditions will form the bulk of the total webinar today. Terrorism changes as well. I'm sure you'll all know 2 or 3 months ago, Pool re-announced some changes to their own underwriting approach, and I'm going to touch on how that is going to impact on overall costs and also the insurance premium tax increase. I know it's 6 to 9.5%. Doesn't sound a lot, but it's over 50, just under 50% increase. But taking into account that increase with various other aspects that you might be seeing at renewal, it can make quite a significant impact on those premiums. So firstly, looking at the FCA, this is really aimed at managing agents. As you know, to transact insurance, you need to be any of these in terms of transacting on a legal basis. Direct authorisation with the FCA is the most onerous. RICS have their designated professional body arrangements, which you obviously need to meet in terms of their requirements and audits that RICS carry out. But those two, in effect, are giving you authorisation to transact insurance on behalf of clients where you're a managing agent. Appointed representative. Larger managing agents will get appointed representative status either directly with a broker that they do business with or via a compliance consultant that will then allow you to deal with a number of brokers subject to the arrangements that you have with that compliance consultant. Any of those, obviously, you have to follow the rules and regulations, of which there are countless rules and regulations, which I'm sure you're aware of, to ensure that you correctly transact insurance and also that you fully inform and keep your clients up to date. I'm just going to touch on the next one on that list, the introducer appointed representative, known as the IAR. Unfortunately, there are a lot of brokers that don't necessarily fully understand the implications of dealing with you on an IAR basis. that only allows you to introduce business to a broker or an insurer. It doesn't allow you to transact insurance. You have to be very careful if you're on an IAR basis, and bearing in mind that anybody within seconds can go onto the FCA register and can check your status very quickly as to what your status is. Are you direct through RICS, appointed representative, or the introducer appointed representative? Now, if you're on that IAR basis, if you are getting involved in the actual transaction of insurance and dealing with claims above and beyond what you would normally do as a managing agent, you probably have to have a look at that again, because you will be breaching the FCA regulations. Just at the bottom there, if you're appointed as a company secretary, that will allow you to transact insurance, but ensure that your company secretary arrangement is on the same capacity as to how you transact insurance, because that again can have implications. So why are all of those important? Well, as harsh as it sounds, if you transact insurance and you're not compliant, you are committing a criminal offence, which is very worrying, because it's huge implications, particularly if you have an errors and omission issue, because your professional indemnity insurance would not cover you for any illegal activity. As I say, it's harsh, but that's what the FCA produced. That is their guidelines. So if you are not in line with FCA requirements, if you have an issue against you, your PI policy may well not indemnify you, which could create further issues. So that's why it's very important to ensure that you're on a compliant basis. Firstly, as you can see, we've got a unicorn on this slide, because like-for-like quotations, they are a myth. It is a vastly overused phrase in the industry, because you can never get a like-for-like quotation, and I'll run through the reasons why and look at some pointers shortly. No two policy wordings are the same, and one sentence can make a difference, and again, I'll highlight that for you. Indeed, some insurers, some of the larger insurers, will have 3 or 4 different types of property owners policy wordings. Some will be for the smaller landlord with small individual houses. Others will aim purely at residential leasehold block arrangements. Some will be on a commercial footing, some will cross the two. So even if you're with one insurer and then you change or renewal comes up, you may well see some changes happening. And that last point there is that when a renewal comes through, the paperwork that is attached to that or comes through the post will have details of policy wording changes. And if you renew a policy without fully checking those or taking them into account, you have automatically accepted the revisions to those policy wordings. So when you're looking at alternative insurers, for alternative quotations, you are not getting a like-for-like quotation, because the policy wording will be very different. Purely focusing on price is potentially increasing the risk of uninsured losses by taking a lesser policy wording that will impact either on the freeholder or the leaseholders through service charges. And the reasons why I'm focusing on this is because those in effect are the key areas. Whenever I'm asked to provide quotations for property insurance, these are the general information that we get through and that we focus on. You've got your sum insured and your declared value. One quick point, all insurance that you arrange on buildings should be on a day one reinstatement basis. That will give you an automatic uplift to protect against the effects of underinsurance and inflation. We won't go into detail. We could talk for a whole hour on day one declaration, but those are the key points that you will see on a certificate order schedule. Obviously, the indemnity period and the monetary figure for loss of rent, that generally relates to commercial. Residential is normally stated as a percentage of the building's declared value or sums insured. So those are the key areas that are normally focused on when somebody is looking to arrange an alternative quotation. Now, as an industry, we are overly guilty of probably simplifying the quotation process. The reason being is that the industry probably sees tens of thousands of requests for quotations each day, so it has to be a streamlined process, otherwise nobody would ever get anything done. The danger is that you supply a broker or an insurer with some basic details, obviously the address and everything else to do with the risk, but construction details, the claims experience, the occupancy information, and what I've termed there as to the heads of cover. And those heads of cover are the ones that we've just looked at on the previous certificate, which are all the key pointers on what the premium is actually going to be based on. So we, as an industry, make that too simple. And the problem is that when we then forward you the quotation, we send through to you confirmation of what the sums insured are. Those can be very quickly checked against a current schedule or current certificate, along the example that I've just shown you. And the danger is that assuming that means that you have a like-for-like quotation. It's been worked on the same sum insured, it's been worked with the same indemnity period, it's got the terrorism cover or it hasn't got the terrorism cover, and then all the focus goes on to the premium. What you will have, or what you should have, because a broker has to be compliant in how they process everything, is that then you will have a huge amount of paperwork or lots of attachments to that email that sets out all of the nitty-gritties. That's when you've got your full policy wording. We have to issue you with the demands and needs statement, terms of business, key facts, which is only a summary, and then obviously the premium. That is a lot of information to get through. And obviously, if the focus is purely on premium, the policy wording can be overlooked. So with all that information that you've been provided, that is then needs to be looked at and should carefully be considered in terms of the full terms and conditions. Has that policy been checked? Who has checked that policy wording? Even if you are renewing a policy with the same insurer, check the attachments to see what amendments are being made to that policy and what you are automatically accepting if you renew that policy. Now, this is a job for the broker, and a specialist property insurance broker should do that job for you. They should point out what the differences in cover are. Because if you are moving to another policy because you are looking for premium savings, I'm going to show you some examples as to how that can come back to haunt you if these areas haven't been checked. Have the exclusions been considered? How do they differ to the previous policy wording? Any subjectivities in terms of surveys or warranties or inspection requirements? A lot of policies have standard conditions to inspections of policies, and some of them, if they're not adequate or they're not practical, will go beyond the common areas of the property, which obviously is beyond your control as a managing agent. Now, what I'm going to show you now is some claims examples. These are to illustrate some of those areas of exclusions that have crept into the industry that you may or may not have in your policy wording. You may or may not be aware of them, but at the time of a claim, you do not want to become aware to some of these exclusions. So I'm going to go through these to highlight what I'm talking about. And I'm going to just add, most of these are from major insurers that you will know that you may well have policies with, or you may be considering moving a policy to. And all of these areas that I'm talking about will affect residential leasehold apartments, residential lets, and also residential portions, and to some extent commercial portions of mixed developments. As a specialist property broker, we issue bespoke wordings, and none of these exclusions apply to our own wordings, and these are areas that you should be seeking from a property specialist broker when you next look to review. So let's just give you the first example. We see a lot of these instances for various reasons. So a claim is submitted. We've just been through the process we've talked about. You've provided all the information. You've made a change of insurer. You've saved 10% on the premium. And then the claim comes in. Large block of flats. The domestic dispute has led to damage to kitchen fittings, damage to windows. And somebody basically has run amok within their own flat for whatever reason, and these are all claims that actually have a reason that we've dealt with. £9,000. You submit the claim, but your insurer says, sorry, you're not covered. Now, if you weren't aware of that, you would then need to find out exactly why that has been repudiated and explain fully to your client. So on this particular claim, this is a policy wording from a major insurer. I've just highlighted that one particular area, and the reason why that particular claim isn't covered is because it excludes damage by persons lawfully on the property. Now, persons lawfully on the property will be leaseholders, tenants, their family, their friends, their visitors and callers, and damage arising as a result from somebody lawfully on the premises is excluded from this particular policy. So you have to ask yourself, was that covered on the policy that we moved from to take out this policy? Because, as you can see, this is one sentence within a vast array of policy wording that has just cost £9,000 in uninsured losses. The handout that I can offer you does use all of these examples, and these are key areas to quickly look out for and can quickly be established from any policy that you are looking to take out. And as I mentioned, it's the broker's job to inform you. Now, the reason why this exclusion has crept in is because insurers are looking, in effect, for owners, freeholders, property managers to take a tighter control and risk management. Obviously, you can take references, but it never accounts for the unexpected. So that is the first key area. Damage by persons lawfully on the premises is excluded. Some policies will exclude it only relating to their own specific portion. Others will exclude it entirely for the whole premises, which this particular example does here. Next example. We all know that water damage is prevalent and is probably the main cause of any claim within a leasehold property. On this example here, water damage can be very extensive. This is a small claim as far as water claims go, £15,000. Now, in this one, caused due to inadequate sealant around the bath and the shower. And again, you're shocked to find out that the insurer has excluded it. Now, as a managing agent, your responsibilities are to common parts. You're not going to be seeing individual apartments. You're not going to be looking at the sealant. Most leaseholders won't necessarily realise. Most tenants possibly wouldn't realise or even care that there was damage or inadequate sealant around the bath. So this particular claim would have been excluded, and this is from a major insurer that does a lot of property. And this exclusion, one sentence again in a whole policy document, excludes loss or damage caused by the failure or lack of grout and or sealant. Now, when I first saw this exclusion, I was shocked by that because I found that that was to be totally unreasonable. And the impact never normally is in the property itself, it's normally the flat below. And whether a freeholder can recover such costs that are uninsured, and the impact on leaseholders, a £15,000 claim is a small water damage claim. They can run into tens of thousands of pounds. If that can't be recovered because of this exclusion, who's going to pay that? How is that going to be recovered? It will be the lease that determines. But if you've moved on to a policy wording that has such an exclusion as this, then that is a major concern, because it's quite possible you move from a policy that previously covered it. How are you going to explain that to those people that are directly affected by having an uninsured loss of that nature? Another example, a vacant flat. We all have vacant flats within blocks. They're going to be vacant for many different reasons. This particular claim, damage caused by a leaking water pipe. Investigation finds that the flat has been vacant for over 30 days. Nobody's inspected it. As a managing agent, you might not even be aware that that flat is vacant, or the reason why. No heating was left on, the pipes weren't drained down, and this claim cost £25,000. The claim is submitted, and again, an insurer has repudiated. So why would this claim be repudiated? Well, vacant and unoccupied portions, there's several areas here. Firstly, take a look at the example of this particular policy. How do they define unoccupied? Now, on this particular one, the definition of an occupancy includes buildings or any part of any buildings. Now, that is a significant, very wide definition of unoccupied. Many policies will include part or portion of a building, and they may term it as unoccupied or vacant. They'll use either word. Now, if you have a policy that defines unoccupied or vacant as including any part or portion of any building, then you are, in effect, triggering a lot of additional requirements and exclusions. So this particular claims example firstly has that definition, which then triggers the unoccupied buildings exclusion. Now, bear in mind that this includes part of or portion of buildings, and the first exclusion there is damage by escape of water. Those other exclusions as well will automatically kick in, normally after 30 days where the property has been unoccupied. So you suddenly are increasing the risk of uninsured losses by not having any cover for those other areas. Obviously, these areas are probably most likely to be what damage does arise to an occupied building. So the first part is to check and be fully certain as to how a policy defines unoccupied. It is far, far better to have a policy that purely defines unoccupied as wholly unoccupied. If you have a policy that defines that as wholly unoccupied, the chances of your block of flats being wholly unoccupied are, of course, very slim. So immediately you are taking out that particular exclusion, although you would still need to check policy wordings because excess levels may increase. This particular one also increases the excess for any insured losses to £1,000. Now, the other reason that this particular claim could be repudiated is that the unoccupancy condition also triggers requirements on yourselves or freeholders to ensure inspections. Now, the problem with this particular wording is that if you have a portion of the property that is unoccupied, then you have to inspect it internally at least weekly and keep a record of those inspections and any defects. The policy does give you a slight caveat in the sense that immediately you become aware, but then you also have to be aware of the reasonable conditions, reasonable precautions as to is it reasonable to understand and be aware that a part of the building is unoccupied, how closely is it managed, how hands-on is the management of that property. So again, that definition triggers the exclusions and also the reasons as to why it needs to be inspected. Now, inspecting a property weekly is onerous task. Many policies can extend that to fortnightly, 3 weeks, or in some of the cases through specialist brokers, ourselves included, every 45 days. But if that definition of unoccupied is changed to wholly unoccupied, then it means that it's taken out the requirement for those individual inspections. So again, it's just one sentence or a few words within a policy document that are immediately changing the rules when it comes round to a claim. Another example here, and this is something that we see an awful lot of. We've had at least a dozen in the last 6 months, and it's a growing issue, as I'm sure you're aware. Sky News did a 20-minute feature on this not so long back, so you know it's major news when you have that amount of time dedicated to it. So here we have a claim submitted. It's damage to a flat, the tenant's disappeared, and cannabis has been discovered. Not only has there been damage to the electrics and then water damage by watering the crop, but there's also been damage in this incident by gangs that are stealing the crop. We've had an incident where it's not just the police that have the heat-seeking equipment. Gangs will use these to try and identify which properties are growing cannabis. They'll monitor, they'll watch, they'll wait for the stock to be ready, and then they will go and take it. And in a block of flats, they never get the right flat first time, so you will find that damage can be quite extensive. So here you are, you have a £40,000 loss for all of those reasons stated there. The claim is submitted, but again, the insurer repudiates. And it comes back to, if you've not checked the policy wording closely, notifying clients or freeholders of the repudiation after the loss is never good. Here's a first example as to why that claim could be repudiated. This is one of the largest insurers in the UK, and this is a wording that they generally use for smaller property owners, but I've seen this policy wording used on some pretty substantial and larger portfolios. Now, that's a pretty wide-reaching exclusion. Total exclusion for any loss or damage caused for any illegal activities. You cannot control what leaseholders or occupants, tenants get up to. You can take references, but you cannot control that. So that is a significant exclusion that would impact severely on a freeholder through an uninsured loss where they can't be recovered, or on service charges. Another reason why this claim could be repudiated, and this is a frequent one that I come across when carrying out reviews. This is also a major European insurer, and this is a policy condition specifically called the illegal cultivation of drugs, and this has to be checked very carefully. Look at that condition. You must carry out comprehensive and internal surveys of the premises at least every 3 months and maintain a log. Now, the definition of premises would include, in this particular policy, every single apartment. Do you really wish to try and arrange a 3-monthly inspection of every single apartment? Can you imagine the response you would get from occupants? Can you imagine trying to schedule that so you can do everybody in the same day? It would never happen. It'd be like painting the 4th bridge. You would never complete that. But this is a policy wording and a condition that if not carried out, the claim that we've just highlighted would be repudiated because you cannot prove that you have carried out those internal inspections. Insurers impose this one to try and combat the alarming increase in cannabis farms, which we've seen through claims examples. Now, again, you should not accept a policy wording that puts that onus on you, particularly if you're not aware of it. And frequently I will talk to managing agents carrying out a review, and they're not aware of it. And I'll open the policy document that they have. I'm sad enough to know the page that it's on, and will point to it, and it's the first that they knew about it. A broker should point out all these subjectivities. A specialist property broker should not have that condition, and it can be removed. We've successfully removed that condition. You still need to obtain references and bank account details, but you'll be doing that anyway. So that is a major area to ensure that you don't have in your policy wording. Those are just some highlighted major areas that can be looked at and discovered very quickly that should have been pointed out to you and should be looked at before any changes. So consider the aftermath. If you have made a change to policy wording that was previously covered and is now not covered, you could be held negligent for those losses because you have recommended a change in policy that has removed some policy wording. Were policy wordings compared thoroughly? What would your freeholders or leaseholders be seeking to do if they believe that they have been inadequately advised? Again, this is a broker's job. Now, many of you will have partnerships with brokers that will be doing a work for you, either on an individual policy or a portfolio arrangement. But these are all areas that will need to be checked. And policies are available that do not have any of the aforementioned exclusions, and so will not impose any of those potential risks. I liken a policy document to a lease. You have the heads and the main pointers of a lease as you do a policy, but it's the policy wording or the lease that is referred to in the event of legal issues or claims, and that's why it is so critical. So how do you combat these? What action can be taken? Well, I would say this, wouldn't I, as a specialist property broker, but the insurance market is no different to many other professional advisors these days. Many brokers have gone down niche routes. It is becoming harder to be all things to all men. So you seek specialism within a professional industry that does specifically focus on these points. Don't accept a standard insurer's policy wording. Off-the-peg policies are rarely there for your advantage, and insurers look closely at these policy wordings each year and will tighten policy wordings as risk increases. If you use a specialist, they will often have an enhanced bespoke wording that should have already addressed these issues, so reduce the risk of uninsured losses. We've talked about comparing policy wording. And also ask specific questions. I've got a checklist I can send to you that covers all these areas, and those can quickly be checked. A broker should be doing that already, so in effect you'll be doing his job for him, so it should lead you to question as to why that hasn't been done. So those are just the key pointers that should be checked before you make any changes, and these are those just as a summary of what we've just talked about. Lawfully on the premises, you may think that the risk is minor, but as I say, we insure about 14,000 properties around the UK of all sorts. We do see claims of this nature for all sorts of reasons. Policy excess levels are increasing, and again, those should be checked because those can impact on service charges. The £500 or £1,000 policy deductibles for malicious damage are not unheard of. The inoccupancy definition is very important. Is it a wholly or partially definition? Because as we've seen, if it includes partially vacant within the definition, that will trigger those conditions and exclusions. The escape of water exclusions, the one mentioned about the failure of sealant and grout, is coming into more policies, and you have to consider as to whether the risk management and maintenance is really going to protect the occupants should losses arise of that nature. Those illegal activities have to be looked at very closely too. And as I mentioned there, and I know I'm harping on about it, but you employ a broker to do the job. You don't expect that broker to manage the properties for you, so a broker should not expect you to have to do the insurance work. I'm going to look at how you can avoid these issues, apart from what was on the previous page. Managing agents either arrange policies on an individual or a block portfolio basis. As a specialist, most brokers will do both. We do both. Depending on the size of the portfolio, there are advantages. But if you have a large managed portfolio, whether you own all of those or manage them on behalf of a freeholder, there are advantages to bulk buy and strengthen numbers, because it will often give you access to the enhanced policy wordings that I've talked about and can take out those exclusions, reducing the risk of uninsured losses arising, reducing pressure on service charges by having insurance claims paid, and obviously taking some of the potential pressure off yourselves where you are transacting insurance. Your clients will see you as being advisors as to why insurance is placed. Yes, you have directors of RTMs that will be taking those decisions, but you have to obviously question as to the value of advice and the potential where that advice is taken up. The main advantage of a block portfolio is that it will create a uniform policy wording and terms and conditions across all locations. And if that's a wide policy wording, then you have more peace of mind in terms of not having to check every individual policy on a specific claim where it arises, because that policy could well or will differ from a policy that you arrange for another property if you do it on an individual basis. The bulk buy principle will also allow you, in most cases, to remove or reduce policy excesses. Escape of water policy excesses tend to start at £250, £350, £500. In practice, you can often double that, because you often question, is it worth submitting an insurance claim for £700 if you've got a £350 excess? Some choose to, some don't. But the implications again are as to where do all of those non-submitted claims and policy excesses recovered from. Often as well, you will benefit from increased limits and more competitive rates if you seek a block portfolio. But many specialists will work on both bases, and that is a commercial decision to make as to what the advantages are, and very much worth a review to strip out all those issues that we've just talked about. I'm going to touch on, before Nicholas becomes involved, some recent changes. If you have a look at those zones, Pool Re are one avenue for terrorism. Pool Re was a mutual insurer set up in the 1990s, which originally came about due to the actions of the IRA with their mainland bombings. The insurance industry could no longer afford to absorb the hundreds of millions of pounds per incident, and so the arrangement was set up for Pool Re to take the strain. And all major UK insurers sign up to Pool Re and offer terrorism cover as an extension to policy wordings. Quick word, residential leasehold block insurance does not automatically include terrorism. Unfortunately, we see a lot of non-standard property brokers assuming that it does because it's residential. It automatically is included on household policies, owner-occupied single household policies, but not for leasehold terrorism, not for leasehold blocks, and I'm sure most of you are aware of that. So what have Pool Re done? They've looked at how they rate their premiums and how they can underwrite the risk, and how it can be applied to the modern day risk of terrorism, which changes year on year. The major change is Zone A has seen a 10% increase on the terrorism rate with Pool Re. Just giving you an idea as to what those central London postcodes are where that increase is applied. All other areas, the rating has stayed the same. So how much does it cost? Well, most insurers that operate Pool Re, they'll have slight variations between them, but this is what you would expect to see. Now, before the changes, per £1 million in buildings declared value, that's BDV, buildings declared value, assuming a 10% commission level, that's the sort of area that you would expect to see the premiums to be. Zone A and B were undefined between each other. C and D, the rest of the country, significantly less. After the changes, you can see that Zone A has crept up. Now, that might not look much in isolation, but I'm just going to show you an example as to what effect that can have when you take into account the IPT increase and also potential market rate differences. So let's just have a quick look at this. So you've got a 10 million BDV for a residential leasehold block in Zone A. Assuming it's run fairly well, you'd expect to see a premium of about that level if it's insured in isolation. If it's in a block policy, maybe considerably less. So on this one, terrorism as before, insurance premium tax at 6%, and there's your premium. Now, you come up to renewal, you have index linking to take into account, you may well see a market rate increase, particularly if it's an individual policy that doesn't have the strength in numbers, and you've got the IPT jumping from 6 to 9.5%. So that same property taking into account the index linking, here the example at 4%, market rate at 5%, with those other increases, terrorism and IPT, you are looking at a significant increase on that premium. It's jumped nearly £3,000 just by taking into account those changes. Now, if you're not prepared for the IPT and terrorism changes, you could well have a significant number of questions and representation from clients, leaseholders, directors of RTMs that aren't happy about that. So it's important to take into account as to what those impacts are, and I'll touch on just before I finish my section as to how those can be potentially avoided. Just going to touch on some other changes to Pool Re. The first one is very significant and, to be frank, very annoying. If you manage a large number of properties and you have them on a block portfolio for a number of individual clients, some of those individual clients will only have small sums at risk. Now, there's the potential of a 40% rate reduction on any individual owner that has a sum at risk of less than £2 million. Now, that's inclusive of any day one uplift. So there won't be many, but there will possibly be a number within your portfolio where you have a managed arrangement under different ownership. If you do not adequately check and ensure that those discounts can be achieved, now the ridiculous thing here is that if it's in zones C and D, that discount will be very insignificant. But if it isn't addressed and in 4 or 5 years down the line you have somebody that says, hold on a moment, we should have had those discounts, we haven't had them, they seek a retrospective action to recover those losses, that's going to be an administration headache. So it's important that you work with your broker to ensure that those that can recover or have a discount on the terrorism are able to seek that. Large loss discounts, if you have a large portfolio, if you take a deductible of £500,000 or more, there can be a discount on premium. Obviously, it depends on where these costs are recovered as to whether you go down that route. There are other arrangements that can be looked at for large loss if you work with national terrorism organisations and security. So those, again, are very significant areas where Pool Re has introduced more of a flexible model rather than a one-rate-fix-all. Just at the bottom there, I've mentioned that there is a loss of rent cover reduction on the rate by 10%. As all residential properties have loss of rent or alternative accommodation as a percentage of the BDV, Buildings Declared Value, that doesn't apply. But a loss of rent premium discount of 10% is available on commercial properties, but that's on terrorism, particularly outside Zone A, is relatively insignificant, so you probably wouldn't even notice the difference. But again, it's important to check that that has been obtained if it's available. There are alternatives to Pool Re, and I've just given you a very brief comparison here. It comes down to policy wording again, but the main differences are shown here. If you insure one property with Pool Re under one ownership, all of those properties under the same ownership have to be insured. It's an underwriting condition of Pool Re. You cannot select against them. So if you have an owner that has properties in central London, Birmingham, Manchester, the sort of key areas that we would see as targets, they also have to include any other properties. Alternative insurers that offer terrorism cover often don't have that restriction, so you can be selective. Major difference here is that Pool Re is underwritten by the government, or it's backed by the government, so they will include that financial backing, which is mentioned down the bottom there. One of the other reasons why Pool Re have looked at their rating structure is because the government required an increased contribution from Pool Re to continue to give that guarantee. So the advantage of Pool Re, who currently sit on funds of about £5 billion, if that is exhausted, then they can call on the government to back them for any excess for any individual incident. Pool Re have paid out about £600 million in terrorism claims since they were first set up. The act of terrorism is also a requirement of Pool Re, where it's not a general requirement on alternatives. Pool Re will provide cover anywhere in the UK. Insurers, being a commercial concern and having reinstatement considerations, won't necessarily always provide cover in the major areas. So those are just very brief comparisons between the two. So how can you look at tempering the potential impact of what we've just looked at with index linking and everything else with the IPT increase and terrorism changes? Well, you don't want to be having increased queries and arguments with clients, so consider a market review. Remember, obviously, the comments we made about no two policies being alike. That's a major part of it. But if you can improve policy cover and reduce costs, then that's a very good outcome. You can secure a long-term agreement, and again, the advantage of a block policy arrangement is that you can either have long-term agreements or rating stability clauses that you often won't get on an individual policy, particularly of premiums of less than £40,000–30,000. Neither of those will secure or protect against future IPT rating increases. That's a tax which is very separate. But if you can do your best to protect or secure underlying premiums, then that is going to help in the years to come if those are honoured by insurers, and rating stability in particular is connected to and assessed in line with claims experience. Also, obviously, particularly in Zone A, you can consider alternative terrorism cover, but again, do be aware of the changes that you will be making if you move from pool re to an insurer that sits outside that pool re scheme that doesn't offer those various covers. The one major one being on the previous screen is that you won't get or rarely get the nuclear or dirty bomb cover that pool re offer. Arguably, are we greater at risk at that than in previous years? Potentially, yes. That's my section. As I say, I'm happy to send any attachments that will summarise what we've talked about today, although I hope we'll find to be of use. So I'm now going to pass over to Nicholas.
Thank you very much, Trevor. I'm going to cover some basic legal aspects of the interaction of building insurance and residential leasehold property. What's going on here? Right. Okay. On to the first slide. Before I touch on the case on that slide, I'll mention the relevant legislation so far as residential leasehold property is concerned. And that's the Landlord and Tenant Act 1985. Located within it are sections 18 to 30, which provide a code of protection for those residential leaseholders of a dwelling, be it a leasehold flat or a leasehold house, paying variable service charges. Now, in particular, sections 18 and 19 state that when it comes to insurance, in addition to other costs like repairs and maintenance, but when it comes to insurance, costs have to be reasonably incurred. And any arguments about whether the insurance costs have been reasonably incurred can be thrashed out at two forums, namely the county court or the first-tier tribunal property chamber in England. They've got concurrent jurisdiction to deal with challenges to insurance costs, principally premiums. And I should say that the first-tier tribunal property chamber exists in England. Before the 1st of July 2013, it was the Leasehold Valuation Tribunal. But in Wales, if you have clients or dwellings based in Wales, it's still the Leasehold Valuation Tribunal and the procedure which flows from that. Well, I'm going to cover some cases that are pertinent to residential leasehold property and insurance, and the first two are basically about certain principles that have arisen. Now, I put up on the screen case of Haven Bridge against Boston Dyers Limited. That was a case in 1994, 21 years ago, in the Court of Appeal. That's the second highest court in the land. Now, it was held in that case that where there's an express term or provision in a residential lease that the landlord could charge for properly, sums paid or expended properly, and I underline the word properly, expended insurance premiums, that left no room for the court to infer any other qualifying words, such as reasonably. So the sole test under a lease which says that the landlord has to act properly is that they should act in the normal course of business when arranging insurance in deciding whether the landlord has acted properly. Right. Okay. Up on screen now is a case that did involve portfolio properties. In fact, I had a flat in Hendon that had one of these that fell within this insurance portfolio many years ago. And it's Berry Croft Management Company Limited against Sinclair Gardens Investments Kensington Limited. Now, this was also a case in the Court of Appeal, and basically they were leases of flats in a block. Those leases allowed the landlord to nominate insurers of repute to be used by the management company for insuring the block. Now, the freehold changed hands. The new landlord nominated new insurers whose premiums were higher than the previous insurers. And the Court of Appeal asked itself, should there be further limitations on the landlord's choice of insurer? Should they be implied? And the Court of Appeal came back with the answer, no. They said the limit on the landlord's discretion had been specified in the leases as insurers of repute, and no further limitation should be inferred. Provided the new insurance was arranged in the normal course with reputable insurers, it couldn't be challenged. And also that if a challenge was made under the 85 Landlord Tenant Act Section 19, applicable to residential leases, that would give the same result. So what one can deduce from that case is that so long as the insurance was arranged in the normal course, the insurance hadn't been unreasonably incurred, even though the premiums were higher than some alternative insurers would charge. Now, this was a case from a couple of years ago in the Upper Tribunal Lands Chamber, again involving Sinclair Gardens Investments Kensington Limited, where the leaseholder of the flat was Avon Estates London Limited. And Upper Tribunal Lands Chamber is the appeal forum from the Leasehold Valuation Tribunal, as it then was. And the principle that came out of that case, and I'll dwell on the flat shortly, is that the landlord is not obliged to shop around to find the cheapest insurance, and that so long as there's been adequate market testing, and I'll come on to what that might mean in a second, to justify a reasonable to go with the quote. Now, the facts succinctly put on that slide were these. It was a terraced Victorian property, 7 Castlewood Road, Stoke Newington, London, N16. And the building insurance obtained by the landlord was at a cost of £4,154.25 for this terrace property converted into 3 flats. There was a challenge to the alleged reasonableness of the insurance, and the figure was upheld by the LVT. The leaseholder appealed the LVT's decision, and evidence was submitted of an alternative quote of £1,011.60. Now, the Upper Tribunal Lands Chamber came to the conclusion that the landlord had a very wide discretion with respect to insurance. So long as that insurance is obtained in the market at arm's length, then the premium could be said to be reasonably incurred. The landlord had obtained comparable evidence to support the level of insurance premium, and there was nothing to suggest that the insurance arranged was otherwise than in the normal course of business. So what the court went on to state, the Upper Tribunal went on to state that the words properly testing the market do not detract from the decisions in Berrycroft and Haven Ridge that the landlord must prove either that the rate that the premium was representative of the market rate, or that the contract was negotiated at arm's length and in the marketplace. So I think it's going to be difficult to challenge insurance premiums if they've properly tested the market.
Quick point on that, Nicholas, actually, which we come across frequently.
Right.
is that where you have occupants challenging the premiums and they come with alternatives, first of all, it comes back to the point about the extent of policy cover and comparing, they're really the same. But the other major risk is that occupants, even directors, are rarely fully aware of the full claims experience or indeed the outcome or costs. So you often find that alternatives to test the landlord has been got on an inadequate basis without full disclosure of claims. So that always has to be fully checked as well.
Okay, thanks very much, Trevor. The next case covers the topic that you also touched on terrorism insurance. And this was Kadime against Bath Buildings Swindon Management Company. And we're back at the Upper Tribunal Lands Chamber. Now, here, the leases didn't include a specific express obligation to insure the building against risks posed by the terrorism. And I'll come on to the lease wording in a second because it's quite interesting. The leases required Kadime to insure in accordance with the Council of Mortgage Lenders' recommendations, and the Upper Tribunal came to the conclusion that terrorism insurance cover, the cost attributable to terrorism insurance was not recoverable through the service charges. Now let's have a look at the lease wording. And the lease wording, the obligation on the landlord was to keep the building, including the demised premises, that's the flat, insured to its full reinstatement value, so far so normal, against loss or damage by fire and the usual comprehensive risks in accordance with the Council of Mortgage Lenders' recommendations. I haven't seen any leases until now, in this case, which referred specifically to the Council of Mortgage Lenders' recommendations. And it went on to say, in that respect, from time to time, and such other risks as the landlord may, in its reasonable discretion, think fit to insure against. Now, I'll say a little bit about the Council of Mortgage Lenders. Basically, its handbook with its recommendations are standing instructions to conveyancing and solicitors acting on the acquisition of a property. They set out specific requirements, particularly in respect of residential leasehold property. And you'll appreciate from the terms of the lease on that slide that the obligation's in two parts, against fire and usual comprehensive risks in accordance with Council of Mortgage Lenders' recommendations, but also in addition to second prong, such other risks as the landlord may, in its reasonable discretion, think fit to insure against. So no specific reference to terrorism insurance or activities caused by terrorism. Did it cover risks, terrorism insurance? Well, the building insurance policy that the landlord obtained did include insurance against damage caused by acts of terrorism, and the leaseholder, Kadime, said the terrorism element, we dispute it as it's considered to be unreasonable. And the tribunal found, that's at first instance, the Leasehold Valuation Tribunal, there was no contractual obligation to obtain terrorism insurance. You'll appreciate from the wording, no specific reference. That the landlord had not exercised the discretion, the second prong, and even if they had, the decision to obtain terrorism insurance was unreasonable. The landlord appealed to the Upper Tribunal Lands Chamber. And what was the outcome of the appeal? Well, they looked at the Council of Mortgage Lenders handbook, and that included recommendations to insure against explosives. And they looked at various definitions of explosives, including previous case law and in dictionaries. And terrorism clearly was capable of giving rise to explosions. So the obligation to insure against the outcome, it was an obligation to insure against the outcome of terrorism, namely an explosion, and not any particular method, such as terrorism, by which that explosion might happen, might take place. Now, as a backstop, the Upper Tribunal said that if that particular view was incorrect, then we look at the whole discretionary part, and they said, yes, they had properly exercised their discretion. They'd made a conscious decision to take out terrorism insurance, and it was a reasonable one. Moreover, the Royal Institution of Chartered Surveyors Code of Practice on Managing Building recommended taking out terrorism insurance, and that as a public duty, their code of practice should be afforded great respect, and any departure should be well reasoned and justified. So they took the view that it was either within the risks covered by the building the freeholders' covenant, or within the discretionary element, and they had exercised their discretion, and that exercise and the way they'd gone about it was a reasonable one, the decision they'd made.
I think as well, just following on from that point is, I mean, I would say that 90+% of clients do insure for terrorism, but where it is specifically requested or instructed that it is not required, it is very important to fully document that that decision has been made, and the advice of strongly recommend terrorism cover hasn't been taken up, and it should be revisited at each renewal to ensure that you fully document that that has been requested not to be insured, so your records fully state that that has been considered and the risk has chosen not to be insured. Because the risk changes and it should be reviewed again at each renewal.
Okay, the next case is quite a well-known one, but it's on the important issue of commission. That's a case of the High Court back in 2001, Williams and Southwark Borough Council, London Borough of Southwark. And here it was about commission, the landlord deriving income available from arranging insurance. The landlord first insured under a block policy, under which the discount or commission was entitlement of 36.5% of the gross premium. They later went under another block policy where the discount was 25%. 5% was attributable to a loyalty bonus, and the remaining 20% for providing certain services. Now, what they said is that they only reduce the premium being passed on to the leaseholders by 5%, because the 20% was properly attributable to services provided by London Borough of Southwark, who've been administering and processing the insurance. But I'm wondering if you've got anything to say about levels of commission.
Yeah, it's an increasing focus now. Obviously, the way that property insurance works, it's all about distribution chains. You will have a freeholder, property managing agent, a broker, sometimes two brokers wholesale to each other, and an insurance company. And that's a lot of mouths to feed. So it comes down to reasonableness and also added value. Most specialist property brokers obviously have commission share arrangements with managing agents and indeed landlords, freeholders, that have to carry out certain administrative requirements to process the insurance. So the test comes down to added value, work involved, and not forgetting obviously considerable work involved in terms of claims. Nicholas knows more about case law in terms of those areas where commission has been recouped on a retrospective basis if it's deemed to be unreasonable. It's very hard to put a percentage on what is deemed to be reasonable, but if you can justify and show your added value, where your expertise and assistance and service contributes to that whole chain of distribution from the insurer through right down to the freeholder, then that should be deemed reasonable. And if you consider that you're comfortable with level of earnings, but there is more pressure on it, as I'm sure you know as well as I do, and far more focus on commission levels throughout the industry, and I expect we will see more changes via the FCA before too long too.
Yeah, I should say that we've revamped our list of tribunal decisions on our website, so there's a sort of search facility. So if you're looking for cases about insurance commission, either the old LBT or the First Tier Tribunal Property Chamber, do type in the appropriate wording, and that should reproduce current and past cases. They're not binding precedents, but they'll give useful guidance. I think we're running out of time a bit, so I would have just mentioned, hot off the press is this very recent case of Sadair and others against Mirhan and Asniv Bowring. and I've got the case citation there, another case of the Upper Tribunal Lands Chamber. This dealt with basically a proportion of insurance premium attributable to enhanced risk from a commercial premises, a commercial weighting. The extent of the commercial premises, it's increasing the building insurance premium where it's a mixed-use building with flats as well. How much of that risk should be passed on to the residential part, the flats, and also property owners' liability cover under service charge provisions. Well, the property owners' liability cover or insurance was meant to means here insurance in respect of a property owner's personal liability to third parties. Now, what happened here is that the Upper Tribunal focused on the fact that the leaseholder's interest wasn't noted on the policy, and what they came to was this, and I'll read the words of His Honour Judge Huskinson at the Upper Tribunal Lands Chamber. The part of the insurance premium which is properly attributable to property owner's liability was reasonably incurred and would form part of the costs upon which the service charge should be calculated, provided that the property owner's liability extended to cover the appellants, that is, the leaseholders. If it did not do so, then in my view, that part of the premium is not reasonably incurred and should not be included as part of the service costs. And then they decided to remit it back to the first-tier tribunal to decide how much that remission should be. The commercial weighting aspect was approached like this. Basically, there was a dry cleaning business on the ground floor with flats above, and the premium was split 1/3 to the commercial element, 2/3 to the residential element. The insurance premium was weighted, however, to take account of the commercial use of the ground floor, the dry cleaning business. But what happened is that they hadn't adjusted the apportion of the premium to load the commercial use weighting onto the commercial part, the dry cleaners. And the leaseholders argued that all of the commercial weighting elements of the insurance policy should be borne by the dry cleaning business. Now, the Upper Tribunal's approach, again, H.H. J. Huskinson, said that I do not accept the tenants of flats in a mixed-use building such as this are entitled to demand they only pay an insurance premium calculated as if the building was something that is not, namely as if it was 100% residential building rather than a mixed-use building. Fair enough, but the approach that he took was this. That he said that the leaseholder should bear a proportion of the commercial weighting, irrespective of whether the commercial operation was high or low risk. But he approached it this way. The lease obliged the lessees to pay a fair proportion of the insurance premium and split it commercial and residential 1/3 to 2/3. But the Upper Tribunal said that the leaseholder should pay 2/3 of the premium payable if the ground floor unit of the building was a normal risk commercial occupier, not the dry cleaning business. So they looked at what was the weighting attributable to the dry cleaning business, discounted that back to as if it was a normal risk ground floor commercial occupier, and that the premium that resulted would be split 1/3 to the commercial, 2/3 to the residential, and then split that way, the 2/3 among the residential. It's an interesting case. And that was the end of our webinar, and we now invite some questions. Have you got some questions on the screen?
We've had a few come through, so I'll work through these. Obviously, it's difficult to give exact answers because it all depends on the usual policy wording and specific situations. The first question, obviously, is quite a general one, actually. Why do some insurers constantly change their policy wordings? Well, sometimes I think they're just trying to be awkward and keep us all on our toes. But the sensible answer is, in effect, that insurers have to constantly assess risk. They have to constantly assess what they are taking on, what they are underwriting, and that they must also look at their exposure in terms of how the risk changes and what their underwriting criteria is and what their exclusions are. So they will have to periodically visit policy wordings, terrorism being one example, in terms of how they've had to amend policy wordings to ensure that they continue to meet their obligations on their reinsurance and also to meet obligations to their shareholders. That's an important point to consider, and it's not just at renewal. You will find that those changes take place. We've got the changes in terms of the Insurance Act that is coming about, and some insurers have already preempted that. Now, that's positive news from a consumer's point of view, so that's actually something that will no doubt be talked about over the forthcoming year as to how that impacts on policyholders as well. So, yeah, unfortunately, risk changes, the nature of risk changes, not just with terrorism, but with the environment, global warming, all aspects of social unrest, things of that nature, riots, civil commotion. Insurers have to keep abreast, and so they will make such changes. Another one, escape of water excesses, they're increasing. We've touched on this one, and particular comment here, obviously, if you've got an escape of water excess of £500, just how worthwhile is it pursuing a claim that only just exceeds that? Well, it's a good point because, yeah, you have a lot of work to do to submit a claim, and you want a broker that's going to streamline that process, minimise the disruption, and deal with the claim promptly. But indeed, yeah, if you've got an excess of £500, are you going to claim for anything less than £750? But the thing to take into account is that, obviously, if you don't recover that loss, then that loss has got to be recovered elsewhere. So where is that loss going to be recovered? Who's going to pay for it? You can look at measures to reduce the policy excess. Surprisingly, and the firm I work for is one such firm, you can get policies with no policy excess at all for water damage excess. It's subject to past claims experience, but it's better to have no excess at all and have more flexibility. You might not still claim for the smaller losses, but it's better to have that option. If you look at how the property is managed, if you look at past claims experience, there are gadgets available that can detect increased water flows that will cut off water. Various risk management measures, if they're in place and the claims experience justifies it, that's how you can reduce a policy excess. Nicer not to have them on the policy than having a high excess, because the danger is once you get it at those sort of levels, even if you're changing insurer, it's harder to actually reduce it from that point the higher it gets. I sometimes see examples where there's been pretty poor experience and there's been excess levels at £50,000, which wipes out pretty much all the potential losses that you would have for water. Not all of them, but the danger is that you will end up reducing the investment value and market value, because if you are looking, or if there's a leaseholder that is looking to sell an apartment and you have an excess of that level or no policy cover at all, the due diligence process by any solicitor will highlight the extra risk from the purchaser who is likely to walk away from that claim. That being said, one particular instance I had where there was a £50,000 policy excess, it's going back a few years now. The reason for the losses is that over a 2-year period, 2 further floors have been added to the top of this property with penthouse suites. There was all sorts of work going on, lots of jackhammers that had loosened pretty much every plumbing pipe within the building, and there had been horrendous loss ratio. As soon as that work finished, the experience returned to normal, and so we were able to entirely remove that policy excess when we looked to pick up that piece of business. So it can be done. Nicholas touched on the property owner's liability, obviously from the is it recoverable item there. Now, question here, what is a suitable limit for property owner's liability? Well, as much as you can afford is the answer to that one. Certainly, even for the smallest of properties, a limit of 1 or 2 million is no longer adequate. I frequently see policy schedules that will still have only a 1 or 2 million limit of indemnity because it's not been looked at for years. Those limits can be exceeded quite quickly. Unfortunately, 2 years ago now, was it? We had some very high winds and there was an incident where I think it was either a chimney or part of the roof fell onto the main road, fatally injuring a taxi driver. There was the collapse of the theatre roof from heavy rainfalls. We do see incidents of this nature arising, and some of them can be quite exceptional in terms of the amounts of compensation. Minimum recommended limit, even for smaller properties, is £5 million. Most policies will automatically include at £5 million. But again, go for the highest limit possible. You can often negotiate, and again, this is the advantage of block portfolios. You can often negotiate an increase from 5 to 10 million across all of the locations with no premium difference at all, or very little premium difference. We have seen incidents in the industry of £5 million being exceeded for individual injuries. It's just another question come through. If you have a potential claim on a policy the day before a new policy starts, however, you are not made aware of it until 2 days after the new policy starts, would it be correct to say that you would go back to the previous insurer to make the claim, even though the policy would have ended? Yeah, the trigger point there is that which insurer is on risk at the time of the loss. So even if a policy, now a buildings policy is on a basis that will ensure that you can go back to that insurer even if the loss isn't notified until some period after. Although you do have to be careful of the claims reporting conditions. Some policies will have reasonably notified in terms of periods. Others will state must be notified within 30 days. So you do have to take that into account. So in terms of that, whichever insurer was on risk at the time of the loss, regardless as to when the policy expired, then that insurer is the one that will deal with that claim. Now, that insurer should deal with that claim regardless as to whether you're no longer with them or not, because they took premium for that period that they were on risk. So it will not affect in any way. The claims department won't take offence or take it personally that you're no longer with them because you were on cover with them at the time. Just bear in mind, there's some policy wordings, and this is more relating to liability, so not necessarily affecting the building side, even liabilities under buildings, but you have some policies that once they expire, then no claims can be made, but that's more to do with your professional indemnity policies, subject to your policy wording. So, yeah, you will always go to the insurer that was on risk at the time of the loss. Now, here's one. I have got time to address this, but I hope you don't switch off on this one because this is a very important point. I get confused. This isn't me speaking. This is a question because I don't get confused because I'm an insurance broker and I should know this. I get confused with day one reinstatement. What is it and should I insist on it? Well, all buildings policies should be on a day one reinstatement basis. If you look at a policy schedule, you should have a figure shown as buildings declared value. That figure is often in brackets. And then you will have buildings sum insured, which is normally above that, and it will include a day one uplift. Most insurers will give 15% free of charge, some 20%. Always get the highest uplift possible. You can get 35 or even 50% free of charge through a specialist broker. And that, again, is essential because imagine that you have a valuation carried out on a property. Let's do it easy with the maths. As of the 1st of January, you insure a building. Building's declared value estimated to rebuild at £1 million. 1st of January, you insure it for £1 million. If you get to the end of the year and you have a sizable loss that totally demolishes, that requires that building to be demolished, you are then already a year beyond when that BDV, building's declared value, was assessed. If you then have a subsequent period of several months before the building can be demolished, the site cleared, 6 months down the line construction starts, a year down the line the property is completed, refitted. In effect, if you have a reinstatement period of a year to 18 months, add that to the year of cover that was in place if the loss occurred near to the end of the insurance period, you are 2 to 2.5 years down the road from when that valuation was first carried out, that reinstatement cost assessment. Larger properties can take many years to reconstruct and rebuild and be ready for reoccupation. So, underinsurance applies at the time of reinstatement. Even with index linking, many policies will only give that index linking up to the time of a loss. Day one reinstatement, if you have a 35% uplift on a £1 million building sum insured, on a building's declared value rather, you have a claim that can be made up to 1.35 million at the time of reinstatement. So all buildings should be on a day one reinstatement. RICS advised that. One quick point to point out is that when you do have a reinstatement cost assessment, do inform the valuer that you have insurance on day one reinstatement, because then the valuer does not have to build in any inflationary factors, because he will only work on the cost of reinstatement as at day one, hence day one reinstatement. That means that the premium is not being doubly paid in effect for inflationary protection by adding that into the declared value when it doesn't need to be. Another quick point, day one reinstatement, the premium is calculated on the lower of those two figures. The building's declared value is not calculated on the uplift. So yes, they should all insure on day one.
Right, oh, Trevor, looks like there's a question for me. I manage a building, and one of the flat owners is taking us to the tribunal. They've just issued an application to challenge the building insurance. I haven't had one of these cases before, and looking at the tribunal's booklet, I expect directions to be handed down. What sort of directions should I anticipate? Well, there isn't any standard directions that you get, but the sort of things I've seen are the following. Some evidence of how you've gone about placing the insurance, evidence you've got about the claims history, and I've often seen a direction saying disclose, if relevant, any commission that's been paid. I don't know if you've got anything to add to that, Trevor. Any possible directions you've seen?
Yeah, I mean, it all comes down to the particular circumstance relating to the particular case. I mean, we always look at things thoroughly in terms of what applies to that particular case, and each one could potentially have a different outcome. So it's very much a case by case, but just taking a thorough approach into assessing all the facts surrounding that before really you can give guidance or any indication as to which way you think that should go.
Thanks. As I've said previously, do have a look at our tribunal decisions database. There are a lot of decisions there about insurance and commissions and impacts of claim history that developed over the years.
Got one, it's quite topical. I mean, we haven't really touched on it, but it is another area that we are going to be seeing changes, and it relates to flood. Obviously, it's been a horrendous situation up in Cumbria with unprecedented levels of rainfall. Now, I saw this morning in the press that the estimated insurance costs at the moment are going to be in the region of about £500 million. And the question is relating to leasehold properties and how Flood Re are reacting to that. Now, just to give you some background, in effect, the insurance industry is looking to do the same with flood as they have done so with terrorism. Now, Flood Reinsurance is being set up. It was meant to be launched earlier this year, but there are various changes still taking place and various underwriting criteria. So it is now due to be launched in April 2016. Now, previously, there had been involuntary agreements between the Association of British Insurers and the government to be able to continue to offer affordable flood insurance, and obviously everybody's definition of affordable is very different. The sole purpose being to support households in the highest flood risk area. Now, Flood Re has been designed to be in place for a 25-year period. During that time, they are hoping that flood cover will be maintained at affordable levels, and there has been more work done with local authorities, insurers and communities to be better prepared for flooding. But as we've seen in the last few days, even with flood defences, you cannot possibly account for all eventual outcomes. Now, Flood Re, they're going to be a publicly accountable body, not-for-profit organisation, and they are raising funds through a levy on household insurance policies, estimated to be about £10.50, I think, at the moment. That doesn't necessarily mean your household insurance will go up by £10.50, but insurers will be paying into that levy depending on their market share. I suspect we will find it creeping into insurance policies and premiums because insurers won't necessarily want to keep absorbing that. But the advantage to all of us, even those of us not in flood risk areas, is that it will keep the housing market moving. There's some several, I think it's 300,000 properties are deemed to be in high flood risk areas. If it becomes that they can't be insured, they'll never be sold or rarely be sold, that will impact on the whole housing market. So that's why the solution is looking to spread the risk. Now, insurers in effect will pass on, the way that it will work, insurers will pass on their flood premiums or the flood element of the premiums into Flood Re, and that's going to be capped to ensure that it is fair across the board. Now, the problem with Flood Re, whilst they will be a single peril insurer, as is Pool Re for terrorism, we're going to get those confused, aren't we? Pool and flood, both with similar connotations, is that there is eligibility, and unfortunately, commercial properties at the moment stand outside Flood Re, as do leasehold properties. Certain smaller blocks, and I think the criteria is 3 or less, where the leaseholder is of that nature, and also the freeholder lives in one of those units, that will come under Flood Re. But unfortunately, that's going to be probably a minor aspect of which properties will actually come under Flood Re. So the problem that we see with the larger leasehold blocks is that they will stand outside it, and if you have properties within those zones, without the protection of Flood Re, and if there is continued impact of flooding, it could create an issue. Now, if you, coming back to a topic we talked about earlier, if you insure on an individual basis, that could create issues for you. If you insure on a portfolio basis, you will often find that you can secure better cover or lower excesses for those properties within flood areas where your portfolio is of a sufficient size that offers a spread of risk to insurers. It's all about the spread of risk. Whilst Flood Re has been delayed, it is coming, should come next year, but you will find that the majority of properties that you insure under your managed portfolios will fall outside of Flood Re. Whether we see changes, because obviously there's impact on smaller businesses as well, whether we see changes in that, who knows.
Okay, that seems to bring us to the end of the questions. What I'll do is I shall hand you over to a short survey, which please complete. Right, I'd also mention the next webinar, which is on the 14th of January 2016. It's the first one of the new year. Did a webinar last month on house enfranchisement basic procedure. So we're going to cover some case law in 2 parts. The first one is non-valuation case law. It's been done by my colleague Olero Ormaloi, and we're going to cover in particular case law that's developed over the years, presumably from 1967 onwards, such as that perennial topic, and you wouldn't think it's the sort of issue that's gone to the House of Lords and the Supreme Court. What is a house? You'd be surprised what could be a house. Contents of the initial notice, been quite a lot of cases about that, and restrictive covenants. So do book ahead for that webinar on the 14th of January. Back to the survey.
Right, yeah, I would be appreciated with feedback on that. I've mentioned, obviously I have various handouts, and specifically the checklist that we talked about earlier on those specific exclusions that will be available via myself. So I'm Trevor Palmer at Pi Property Insurance. Be happy to send that information out to you. Likewise, if you've got any specific questions, always worth having a second point of view, I think. Be happy to address those too for you. Thank you very much for having me today, Nicholas.
Thank you. And I think the words of that Sergeant Pepper Lonely Hearts Club Band, you've been such a lovely audience. And thank you for tuning in. It's goodbye from Trevor.
Goodbye.
And it's goodbye from me, Nicholas Kisson. Thanks very much for listening.